Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'll be your host for the next 20 some minutes here on Options Guide TV. All right, this morning, Home Depot is going to be announcing earnings tomorrow. We will get a good insight on the consumer. It'll be very interesting to hear their comments afterwards. Home Depot recently, it's definitely not taken off like the AI stocks, but it's hung in there. Housing has kind of struggled a little bit, but I do anticipate that there may be a bounce back. But I want to do a trade that's going to take advantage of the volatility in the short term. We're going to look at doing a skip strike butterfly for a net credit, very similar to what we did on Next Power. And we actually came back on Next Power after the earnings report, and we did a double up on that position. We had a very good trade on. The market did what it was supposed to. Well, for the trade, it was the perfect move that you could have, and that the underlying moved halfway to our short strike. So in other words, the market, the expected move on that underlying stock was huge, and it only moved about half of it. And if you get that type of move in a skip strike butterfly, that's always a good sign, because you're trying to bring in the net credit. But what you would ideally like is for the stock to start drifting towards the precipice of your skip strike butterfly, where your short options are at. And then you can actually put it on for a net credit and take it off for a net credit. So we're going to try to do something very similar in Home Depot today. So let's run over to the Tradio Pro software, and we'll start just by looking at the chart in Home Depot. And I'm going to add some days to this. Let's go out about 2,000 days here, make it a very long-term chart. And you'll see that, we're right back into this channel. And we've had a lot of volatility actually for Home Depot, even though, Home Depot is fairly, you don't assume that you're going to have a lot of volatility in the underlying stock. But we've came all the way down to this 300 level. Obviously, if we broke below the 280 right here, we have two touches. That would be not a good sign on the downside. I think that's basically where the support is on the downside. And then we're right at the top of this channel in here, right at that 300 level. Up $5 today, 1.8%. Earnings tomorrow morning on the open, confirming that. Tuesday before the open is Home Depot. And let's go in and look at a skip strike butterfly. We're going to use the nearest term expiration, which is 4 days away, the May 22nd expiration. And we'll start by just looking at what the expected move is. We've mentioned that if you moved half of the expected move, or half, of what the marketplace is implying the move could be, we're going to buy this one, we're going to buy this one, and we're looking at 14 points. So at 14 points, we're going to be about a 20 delta, somewhere around there. That's always like how I like to confirm. So the stock is at 302, add 15, we're looking at about 317, and the delta is 22. So it's right around that level. So we're going to buy that option contract. We're going to buy the 317.50. Maybe we do the 315. Let's start on the 315. And we're going to go 5 points. We'll sell two of those. We got to clear this out. 1 second. We're going to buy. Let's do the 315. So the expected move is right at 317.50. We're going to buy one of those. We're going to sell two of these. And then we're going to skip over. Oops. I want to do the 320. If we can get this done for a decent net credit, 30-40 cents. So we'll sell two of these. There we go. 5 points wide. And then we go 10 points wide. Just a 5-cent net credit. All right. Let's change it up. We're going to go 317. 320, sell two, so it's going to be 2.5 points, and that's all our hedge is going to be. And then we can go 5 points here, See if that gets done for a net credit. 18 cents. No, let's go a little bit wider on that. And let's go here. And we're going to go buy, sell to, and we're going to skip the 20 and we're going to go to the 25 here. There we go. That's a decent net credit. Okay. So once again, this is an alternative to a short spread. I don't think of this as an alternative to a butterfly. The short spread that you would be selling in this case is the strike that you're skipping. And it's right in the middle because I ended up adding 2.5 points. But let me send it to the what if calculator. So your risk doesn't kick in until we get to here, and that's the break-even point, and that's going to be by this Friday. So right here at 320 is where our break-even point would be at. And then from that point on, we have the risk that kicks in. So if I'm looking at potentially doing a short call spread, if we look at the 320 to the 325, that's about 70 cents, right? If I just look at the bid on this trade, 176, and I look at the bid on this trade, that's just a shortcut. It's going to give you somewhere close to the midpoint using the bid on both of them, because one of them you're supposed to be buying and one of them you're supposed to be selling. So in this instance, if we did a short call spread, this would be 176 and this would be one, that would be 76 cents. We're going to embed this well, you're basically selling a short spread to pay for the butterfly, and the butterfly is your hedge here. So from 315 to 317 and a half, we're going to get this done for 57 cents. But from 315 to 317 and a half, that benefits us $2.50. And that's why in the what if calculator, we have something that looks like this. Now, it hurts us right now. If we put it on today and the stock ran up to our strike ahead of earnings and then didn't even get the earnings announcement, we would be down on the position. And the biggest thing here is that if you're correct on your forecast, you need the center option, this option contract that we sold, you need that to wither away as much as possible. And how can it do that? You can have an implied volatility come in or go down, which usually happens after earnings, and you can have time decay to happen. And we have very short-term options that are going to go out to this Friday, the 22nd. So after earnings, this line is going to start morphing towards what it looks like at expiration. So this trade is very interesting in that when you first put it on, here's where the stock is at, your negative delta, just like if you were in a short spread. Just like if you were in a short call spread, you'd be negative delta. You'd want the market to go this direction. But ultimately, it becomes positive delta. And that would happen closer to Friday, to the Friday expiration. But tomorrow, this line's going to get a little bit more even. And then the next day, it's going to start bending a little bit more. And then on Thursday, it might be coming up here. And then on Friday, eventually, boom, it's going to go out right at where the precipice would be the peak of our butterfly, like the trade. So what happened in Next Power that we did? Stock came up, hit the 310 level, stayed right about here, and just kind of hung out for a little bit. And we actually put another one on, and I was able to execute it and get $1 in my account. This one's 57 cents. A lot different stock. Not Next Power was way more volatile as far as implied volatility is concerned and actual volatility. But with that said, so did the trade again, and I don't mind that. Right after earnings, if you get a little bit of a move, vol comes off a little bit, but is a little bit sticky. This isn't a bad way to trade it. Come back in and just do another one of those. And then I also should mention, because I don't want to just mention trades that did well. We actually had quite a few in a row around earnings on Options Guide TV that did well, but we also did a Cisco trade, and we got bearish on it, thinking that it's not in here. It already expired. But we had it in our paper trading portfolio, And Cisco, we wanted to get bullish or bearish on, and we did. We did a limited risk open wing butterfly to the downside. And I don't know if you can see here. Boom, boom goes the dynamite with Cisco. That stock took off after earnings. So this is 16 quarters in a row, if I remember correctly, that Cisco has beaten and had a strong move after their earnings report. Obviously, the data center boom is a big deal. Thinking some of the pushback against the data centers, may cause a little bit of concern, get a little bit of sell-off, but the earnings were just too darn good, and the stock did well. So that trade was a loser, and there was nothing to save. You see this, it went from 102, the gap opened to 116. So there's really no way to trade out of it. Okay. So I just wanted to mention it. I didn't want to ignore it. And here is our other trade. And we did a double up on this, but there's only one in here. But here's the next power trade that we had on NXT. And we can look at the chart here too. So 170. And we only got 1 by 2 by 1 in here. I still don't even mind doing this again. I don't mind doing this trade in next power again, even right now, because vols are remaining high, but we had to move up and now we got to move back. Let's zoom in on the chart. And we came close, 150, this little doji hanging out up here. 156 is about as high as we got. Remember, our strike was 170. So we never really were at risk on this trade. There was never a panic. Ideally, there's no reason to close it either, in that you would like the market to go to 165, 170 by the expiration date, which is about 31 days away. So we did a very short-term one, we did a longer-term one, and then we did another longer-term one. So if you go back and you want to see how all those trades played out, go ahead and just look for NXT inside the Trader Hub. That's the easiest place to find all of them, but also the Trader YouTube, they would be available. And my X account, actually, I post all of these videos on X, and it's my X account is @BrianOverby, at my name. All right, let's make this the official paper trade for the day. So let's walk through it. 62 cents. Let's say 60 cents. Let's get it in here at 60. And here we go. So Home Depot is announcing earnings tomorrow on the open. We see right now the market is at $300.85. We're going to use the shorter term expiration, which is the May 22nd expiration, which is 4 days away. We're going to go a little bit out of the money and stay bullish, but we'll be okay if the market actually goes down in this situation. Then the strategy is a skip strike butterfly with calls. You can look it up inside optionsplaybook.com. You can buy the 315 strike call. We'll buy one of those. We're going to sell two of the $317.50 strike, $317.50, and we'll sell two of those. We're going to skip over a few strikes. A standard strike would be the 320. That would be the normal butterfly. And we're going to buy the 325 strike call. Now, this embeds a credit spread that pays for our butterfly. Based off of the current market conditions, the midpoint for this trade would be 60 cents. That means we'd get $60 per 1 by 2 by 1 butterfly. But we do have additional risk because that short spread is embedded inside our butterfly. So I like to think of these trades as an alternative to a short call spread, in that if the market does go down, we are still profitable on this trade. So anywhere from 315 on down, our first strike in our butterfly on down, we're fine with it because we can make this 60-cent net credit in the account. If it goes up, well, if it happens to blow through the 320 level, well, then we got to start getting nervous. And our break-even point, beyond our break-even point, we're going to have the risk of that short spread. So it needs to make more than a one standard deviation move after earnings in order for us to get in trouble. But there's a gap, there's a potential for a gap up after the earnings. And that's where you can't manage the trade. You can't get out of the trade. And so realize that it's an earnings report. Very rarely will it gap open more than the expected move, more than a one standard deviation move, higher than our highest strike in our skip strike butterfly. But there's still potential that it could happen. All right, that's going to be the paper trade. Let me click send. Boom goes the dynamite. Order has been sent. All right, that's it for this edition of Options Guy TV. We'll be back on Wednesday. We'll look at the Home Depot trade. I might look at, let's do the same thing we did before. Let's look at doubling up on the trade. If we do get a medium move in Home Depot, maybe we'll come back and we'll think about doing this again and doing another skip strike butterfly with calls, much like we did in Next Power. Thank you for stopping in. We'll see you this Wednesday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.